Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our econ show. There's a lot of things to cover in terms of what's been happening. It's a little bit of a shorter show. I know that some of you may be excited about that. I know I am to get to the point on some key pieces. And in the first segment, we're just going to look at quickly global production. We had a really in-depth global show last week, so there isn't a huge amount that has come out since. Then we're going to look at why the Fed won't cut rates. Again, some of the different pieces as we go through the data that's come out. And the reason why we want to talk about this again is because we're heading into June and you're starting to see the market pivot on the views of if there's going to be a rate hike or not. Then we're going to look at consumer spending. So consumer spending, again, even though it was up, and when we look at retail sales, and we'll talk about this, it's still disappointed when you factor in inflation, look at the real spending, and just the trend in which credit card rates are going. And we really want to look at how that's going to set up for the summer, because the summer is really when you have people are free, a bit freer with money. They're going on vacation. They're going to spend a bit more frivolously in terms of some of the different things. So we want to look at how people are really going to tighten up and what that means. Then we're going to look at the European bank credit, which continues to tighten in some of those key pieces. And then we want to look at Chinese data, because the economic data that came out had really easy comps, because you're now comparing against a period when there was lockdowns, and it really disappointed. And we want to look at, well, why? And is it a symptom of something much bigger, which is something that we really want to go through? And could this actually start to spark some sort of fiscal and or monetary action to provide some sort of stimulus? We don't think it does, at least yet, but again, we want to go through those different data sets. So I think it's important to really kind of start off with where the IMF's April forecasts are among the world's largest advanced economies. There will still be growth in 23 and 24. For those that have been following us, we think that this kind of gets a bit worse, especially in 2023. But the one thing that I want to hone in on is when you look at 23 into 24, you can see that there's a sizable slowdown that's going to continue in Japan and the US, which I think is important when you look at, how is this going to progress? And for those that have been watching us, we've been saying, look, it's not that we're going to get this massive drawdown or this big issue. It's going to be this kind of a pain or a death by 1,000 cuts, which is why 24 is not going to be this great stellar year either. It's going to be a lot of slowdowns, spits and starts. China and India you're seeing some pretty aggressive growth. India has continued to be fairly strong. Things are starting to slow down faster now in India, and we're going to talk about that in segment 5. But again, we think that China and India are overstated in these estimates, and things are going to be a bit weaker. But again, it's just, we're not saying that we're going to go into this deep negative move, but we do think that there will be a global recession. All of these things will be negative, and you're continuing to see some of these write-downs as the IMF continues to reduce their estimates for not only 23 growth, but also 24 growth. It's not like they're getting more bearish 23 and more bullish 24. They're getting more bearish on both, which on a trend basis, we think is accurate. Like 23 and 24 are going to be weak years. They're not going to be this big snapback, especially because we do see, rate hikes remaining, or at least these current rates remaining for a long period of time, which is going to tighten up credit and create other stress points. Now, with these stress points, you get downgrades, you get defaults. And so there's no surprise here to see the US and Latin America having the largest increases in downgrades. And again, it's not, a downgrade isn't a guarantee of a default. It just means that their cost of capital is going to go up. So if you're a company, you're trying to manage your business, you're trying to manage CapEx, investments, hiring, as you fall down grades, your cost of rolling debt, of issuing new debt goes up. As your risk of defaults goes up, especially if there's other defaults either in your bond bracket, or I should say rating bracket, or size bracket, that's going to create more fear. That's going to create more hesitancy. And these are things where you continue to see some of this, snowballing, which is why we think that, again, we're still at a very early stage of some of the pain when you look at some of the rolling. And it's not just the US, it's Latin America, it's other areas of the world, Asia Pacific, Canada, EMEA. And that's why it's like when you look at the downgrades in general, the largest just happens to be in Latin America and the US, but you can see it's sizable everywhere and it's only going to grow as we go forward. And a lot of that is because global industrial production, as we showed you with the PMI data, and this is just another look from the World Bank, because again, as we constantly harp on it, we want to look at multiple data sets. So again, we talk about PMI, we talk about local data. This is the World Bank. The World Bank is a little bit behind, but it's just confirming what we know. Global industrial production is negative. It's going to continue to be negative. And because it's such a big part of the economy, especially for the emerging markets, and I should say global economy, it means that there's more pain to come and there's more issues to come in general, which is why we continue to see some underlying pressure points and why we are confident in our view that we're going to continue to see some of these write-downs. The dollar has bounced kind of as we said it would. We didn't think it was going to break 100. We thought that about at 102, you're going to start to see a bit of a rise. And here you can see that we've gotten another one. And it's the PBOC cut the exchange rate, which again weakened the yen, the yuan, weakened the renminbi, strengthening the dollar in general, and you've continued to see that strengthening here. And it's important to look at it because, again, currency used for global payments through SWIFT, the dollar hasn't moved. It hasn't moved since 2013. And when you go back to 2020, when you had that slowdown, we're coming right back to the average. And this is what we continue to talk about. Nothing has changed. So if you look at CNY, that yellow line at the very bottom, you're not seeing a huge change there. It's going up a little bit, but again, we're not saying that renminbi and yuan aren't going to become a bigger part. We're saying that the dollar isn't going to be the one replaced. It's going to be yen, it's going to be euro, it's going to be GBP. Those are the things that are going to get impacted. Now, some of the interesting points when we start looking at the commodity side, here you can see that the SUVs, when you look at their efficiency ratings, they continue to tick higher. When you look at SUVs, sedans, minivans, SUV trucks, pickup trucks, they've all continued to get more and more efficient based on weight reductions, based on engine structures, whether it's going from a V6 to a V4 turbo. In terms of just underlying powertrains, now you have different eco modes. Again, all of these things, which is why we keep talking about that even as we, kind of normalize activity, you still have people working from home, you still have hybrid schedules, and we have a class of trucks and which is the biggest market in the US, that's just more efficient. And it takes time to roll over. The average age of a car in the US is over 11 years old. So it takes time to have this conversion as you start to kind of move this up. And it's only going to get more efficient as these cars move their way down. But then when you look at copper, in terms of industrial activity, continues to come down, which is putting pressure on some of the metals. But as we've also been talking about, Chile is cutting production. There's not as much supply, which again is going to limit the amount of supply, pushing some of those different demand levels and pricing levels. So when we look at fertilizer in general, you can see that fertilizer prices have come down. We've been talking about some of the pressure points in general, but fertilizer on affordability continues to be at a higher level where when you look at fertilizer affordability, there's still pressure there. There's still a lot of issues that continue to roll out. One of the bigger problems that we continue to see is on the wheat side. So for those that have been following us, one of the things that we've seen in general is some of these pressure points. So wheat supplies in major exporters to hit 16-year low. Relative to demand, global wheat supplies among major exporters in the 23 to 24 season are seen to at the lightest level since 07-08. plenty of uncertainty, again, continues to remain around the Black Sea deal. But now it's interesting because some of the wheat fields and some of the failures that we've had happened early enough where you could do what's called a reseeding, which is when you go out and you try to reseed either with the same crop or a different crop to try to catch, at least and yield at least something. But farmers are set to abandon wheat crops at the highest rate since 1917. Again, this is massive. And it's not because, there is a seed shortage, which continues to be an issue, but it's the moisture. There's not enough precipitation. There's not enough soil moisture to make it viable to go out and buy more seed. Because for those that don't know, in order to get seed insurance, sometimes the seed provider will also give you insurance, especially if there's a certain failure rate. But they look at the conditions. If the conditions are harsh, you're not going to get insurance because they're saying, look, this is not ideal for our seed. We cannot guarantee that you're going to get growth. So if it fails, we're not going to reimburse you. We're not going to replace the seed. So you're seeing a lot of this abandonment, which is going to be, again, that continuous concern. Then when you look at fertilizer input costs, some of those have come down. When you look at sulfur, natural gas, ammonia, the natural gas side continues to trend higher. That's something that we think is going to be fairly consistent. And then when you look at USDA expects poor U.S. winter wheat, the lowest ratio since 1917. And the problem is winter wheat and spring wheat are both not doing well, which is why it's going to be one of the lowest wheat per years since, again, going back to essentially the Dust Bowl. So not a good situation for global markets. I know that wheat prices came down after Erdogan said that the Black Sea deal has been extended for 2 months. The problem is we haven't seen any inspections pick up. So one of the things that we continue to stress is, and we've talked about this from Russian export side, or the production cut, when everyone's like, oh, Russia's cutting production. It's like, well, they can cut production, but it's important to look at exports. And production exports are vastly different, and those are very important things to look at. And the same can be said when you start looking at other commodities and the pressure points that remain out there. So that's what we have for you on just kind of a quick global overview. In the next segment, we're going to go deeper into what's happening on some of the, the U.S. economic data points, and especially the ones that are the most important for what the Fed is going to make their decision on come June.